Hello everybody, this is St Charts. This is the first educational video and an introduction to Elliott Waves. So we'll just get started. So what is the Elliott Wave theory? It is a theory based on the findings of Ralph Elliott, first published back in the 1930s. The basic principle is that the market moves in waves, impulsive and corrective. And impulse waves consist of 5 waves, and corrective waves, keeping things really simple, are 3. That is the basic structure of the market. So impulse waves made up of 5 waves, and waves 1, 3 and 5 to the upside in a bullish market, and waves 2 and 4 being corrective to the downside. So let's have a look at how that works in principle. So this is a 5-wave structure to the upside. As you can see here, this is wave 1, as we got there, and that is to the upside. Wave 2 is a corrective move. Wave 3, again to the upside. And wave 4, another corrective move. And a final wave 5. So that's the basic impulse structure. So we'll have a look a bit further into that, and then we have a corrective cycle following. So once we've had 5 waves to the upside, so we've got the impulse wave, corrective phase, impulse, corrective again, another impulse, then we get a big corrective move to correct the entire cycle there. So and that's keeping things simple. We're going to have that as an ABC, and that's a 1, 2, 3 wave structure. So that is the corrective cycle following a 5-wave move. Now, each wave divides into subwaves, and so if we just look at this here, so each wave breaks down into subwaves. So we've got here, so wave 1 would break down into a 5-wave structure. So we've got a 1, 2, 3, 4, 5, and that would be a wave 1. The wave 2 would be a 1, 2, 3 to the downside, so a 3-wave structure. So we have 5 to the upside, 3 to the downside, and then again we have then the next impulse move, the wave 3, which will consist again of 5 waves. We've got a 1, a 2, 3, 4 and a 5, followed by another 3-wave structure to the downside, and then followed by a final wave 5, which will be 5 waves again to the upside. So if we look at that, that's sort of 5. It's 3 waves to the upside, so it's 3, 6, 9 to the upside, and 2, 4 to the downside, followed by another 2 to the downside, which here again that would be broken down in simple terms here, just keeping it really simple. We'd have a 1, 2, 3, 4, 5 because we're in a bear market now, so it's a 5-wave structure to the downside. We'd have a 3-wave structure to the upside, and then another wave B, 1, 2, 3, 4, 5 to the downside, and so that would complete a wave 1. So that's basically the sub-waves within that impulse move. So what are the impulse rules? Well, basically wave 2 cannot cross the start of line 1. So this wave 2 cannot fall below here, below this line here. Wave 3 cannot be the shortest. Wave 1 can be the longest. Wave 5 could be the longest, but wave 3 cannot be the shortest. So that's another golden rule. Wave 4 cannot cross into wave 1, so it can't break below this high here. So wave 4 can't break below that. If it does, it's invalid. And on a wave 5, we should see some divergence on the momentum indicators. A lot of people use RSI, but you can use MACD and other momentum indicators. So that would be the basic structure of a wave 5. So as an example of that, I just had a look over, and KZG is an absolute prime example of a perfect 5-wave structure on Elliott Waves. So as you see there, we've had a wave 1. This is our wave 2. It didn't break below that low there, well, at the start of the wave 1. This is our wave 3. And then we had a corrective structure, and then this here is the wave 5, in my opinion. And now we should see a corrective move to the downside to complete that structure, and then hopefully it will continue its move north again. So very simply put, that is a basic introduction to Elliott Waves. There's many other structures as well to consider, but that is the basic principles behind it. There you go. Thank you very much.